disclaimers. You saw a whole slew of them before. Disclaimers here. I'm putting it in English for you. Everything I say today, it's just me. It's not the AICPA. It's not John Moore. It's not Raymond James. It's just me. Anything I tell you about today, any suggestions, ideas, things to look into, don't try this at home without consulting your financial or your tax advisors. So let's talk the basics. The basics didn't really change that much. We still have 7 brackets, federal taxes, although they did go down mostly. Big change, no more dependency exemptions. That was at $4,000 and something that you got for you, your spouse, any kids you had, anybody living with you. That's gone. That's the bad side. The good side, if you were taking the standard deduction, for a married couple, it was supposed to be, it's a little over $12,000 for 2017. In 2018, it goes to $24,000. So they doubled it. But again, the bad news means itemized deductions, which I'm guessing a lot of the folks in this room probably are using, are not as valuable. Marriage penalty, mostly gone. There's a little slice for very wealthy people where there's still a marriage penalty with the rates, but most of that is gone, so that's good news. Child tax credit. If someone has children under the age of 18, or your children have children under the age of 18, the child tax credit has been increased. It's available to more taxpayers. It's higher, it's $2,000 instead of $1,400. It's refundable to a great extent. And there's a new dependent credit for $500 for, let's say you got mom living with you. Rather than, she's living with you, she's a dependent, because you're paying more than 50% of her her living expenses. You get a $500 credit for that now. Or it could be your daughter's boyfriend who refuses to get a job. You get a $500 credit for him. He probably eats that in a week. The AMT, the alternate minimum tax, we all hated that. We thought it was going away. The last minute they kept it in, but the thresholds, the exemption amounts, all were raised dramatically. In the last year we have numbers on 2015, about 4.5 million taxpayers nationwide paid the alternate minimum tax. The best estimates we have now is that in 2018, maybe 400,000 are going to be subject to it. So tremendous change there in terms of people who are subject to that. That's a coastal problem. California, New York, DC, we all paid the AMT. A couple of changes happened just about a month ago. For your 2017 tax returns that you're filing now, if you had a discharge of indebtedness on your personal residence, hopefully doesn't apply to anybody in this room, that discharge of indebtedness normally is income, it's not income. More importantly, maybe more relevant, if you paid mortgage insurance premiums, they had been deductible, they weren't going to be in 2017, they now are deductible again for 2017. And the above the line deduction for tuition and fees for higher education was reinstated. In many cases, that's more valuable to someone who's paying for their kid's college, their child's college, than the Hope Credit or the Lifetime Learning Credit or the American Opportunity Credit, simply because of the way the thresholds and the phase-outs of income happen. So that was reinstated. So if you have kids in college, you need to watch for that. There were a whole slew of energy-related credits that were extended. If you bought any energy-efficient improvements to your home, make sure you mention it to your tax advisor, because they may have become eligible once again for a small, couple $100, but still a small tax credit. Capital gains, dividends, no change. The rates are still the same. They didn't change. Net investment income tax still applies. We'll talk about that in a little bit, what it actually is and why it's so onerous. Itemized deductions. Big changes here. These are probably the biggest changes to the individuals that affect the folks in this room. The overall limitation on itemized deductions, that haircut that you had to take if your income was over a certain level, that's gone. That's good news. The bad news is there aren't a hell of a lot of itemized deductions left. Medical deduction is still there, and in fact, that threshold that you had to get above before you had any value to it of 10% is 7.5% for 2017 and 2018. Well, 2017 is over, but it means you might possibly be able to deduct something. I know my mom, because of her Medicare premiums, whatever, is able to take a little bit of a medical expense deduction, which she hadn't been because of that change. But if you're going to do things like you have a lot of dental work planned, do it in 2018 because it's going to be more valuable. In 2019, it goes back to that 10% threshold. If you're thinking about doing an improvement to your home that can be considered a medical expense, you're getting a little older, the doctor recommends that you put a walk-in tub. Get the doctor to recommend it. Get the doctor to give you, a written letter that, you need this because you have difficulty climbing in and out of the tub. That's a legitimate medical expense. Spend that money in 2018, might help you reduce your taxes. Mortgage interest. Still can have 2 homes. They didn't take that away. Your existing mortgages are grandfathered. You don't have to worry about them. The $1 million limitation for existing mortgages stays. Take out a new mortgage, though, limited to $750,000 of principal that you can deduct the interest on. More importantly, your home equity line of credit that you used to be able to deduct $100,000 worth of interest on up to $100,000 worth of, no more, gone. Unless you use that money to improve your home. You borrowed the $100,000 to put a sun deck on. You borrowed the $100,000 to invest in stocks. That's an investment interest expense. That's deductible. Investment interest, that's deductible. You borrowed it to invest in your son's business. Boy, was that a bad move. But anyway, that's a deductible expense. But if you just borrowed the $100,000 to pay for your trip to Cancun last year, nah, won't be deductible anymore. State and local tax deduction. This has been probably the biggest news story all across the country. Now limited to a total of $10,000 for income and property taxes. States across the country are trying to figure out ways to get around this so that their residents will be able to deduct it. Personal commentary, most of the folks that were paying over $10,000 in property in real estate taxes and income taxes, especially in California and New York where they're freaking out over this, were subject to the alternate minimum tax, so they weren't getting the benefit anyway. But that's a limitation, and that's a marriage penalty right here because it's $10,000 per tax return. So if you're single, you get $10,000. You're married, you get the same $10,000. Miscellaneous deductions subject to the 2% threshold are no longer deductible. What does that mean? Well, that's a whole long list of things that people don't think about. And some of them are really important to the folks in this room. Well, unreimbursed employee expenses, whatever. Tax preparation fees, no longer deductible. I can tell you we had a lot of teeth gnashing in our office about that one. Hobby expenses. You sell a few $1,000s worth of stuff on eBay. It's a hobby. You're not in the business of selling these stuff. You're just clearing out, the Beanie Babies from the basement. Those expenses, the cost of sales for those goods, for those Beanie Babies, the shipping, buying the boxes to send them out, you won't be able to deduct them anymore. Investment fees, no longer deductible. That's investment advisory fees. Not if you pay a transactional fee when you buy a stock or a bond or a mutual fund. That's included in the basis of the property, of the stock, the security. But quarterly advisory fees, planning advice, retirement account fees for an IRA or a pension plan, not deductible anymore. Legal fees, the reducing income, drafting a will, Writing up a business agreement, not deductible. Safe deposit box, small. Most people don't pay for it now. You have enough money in the bank, they give it to you. But you know what? Every couple of $100 helps. Gambling expenses, gambling losses in excess of winnings, well, that's always been true. So that's not really a change. Here's one that's not on this list. It's on a slide later, but I'll tell you about it now. Casualty losses unless they're from a federally declared disaster. Now, what does that mean? Well, here's a great example, right? Talked about that I'm not in DC. DC right now, most of the East Coast, we're experiencing 50, 60, 100-mile-an-hour winds. The roof gets blown off. Insurance doesn't cover the replacement value of the roof. So I'm out of pocket. Under prior law, that's a casualty loss. I would have been able to deduct some portion of that expense. But unless the federal government declares a federal disaster area because of the storms, it's not deductible.